Kia ora, and welcome to the CoreLogic Property Market Update for Maramarua 2022. Sometimes it takes a few months into the year to get a read of where we're at, but that doesn't appear to be the case this year. 6 weeks in, and there can be no doubting the recent boom is past its peak. Buyers are showing extra caution, and tightened credit is playing its part, with sales volumes down, total listings trending up, and property values showing weakness. The outlook is for much of the same, if not for a building of downwards momentum. The first sign of market weakness was a reduction in sales volumes late last year. But this can be difficult to distinguish due to the impact of COVID-enforced lockdowns and then seasonality. January's numbers may also have been affected by the holiday season, but the year-on-year drop of negative 28% clearly illustrates a quieter market. Of course, the first thought on what's caused such a drop is the changing credit situation. There's no doubt stricter loan-to-value ratio, or LVR restrictions, adjustments to the Credit Contracts and Consumer Finance Act, and tighter tax allowances have all had an impact on demand. These changes have affected different buyer groups in diverse ways. But the CoreLogic buyer classification data for January provides the first real evidence of who has been hit the hardest. And, unfortunately for the government, who are vocal supporters of first home buyers, it's this group which has seen their market share fall the most. You could argue the drop isn't as significant as some of the headlines may have led us to believe, but it's definitely notable. After consistently picking up more than a quarter of all sales for most of 2021 and peaking at 26.8% in July, first home buyers' share of residential property purchases dropped to 24.0% in January. First home buyers' share dropped to a recent low of 22.1% in March 2021. But back then, it was increased investor presence which diluted their market share, as investors made the most of the tail end of no LVR limits being in place. This year, investor activity is also subdued, while other owner-occupiers, or movers, are making the most of a less competitive market. Their share rose to 29.6% in January, the greatest monthly share in almost 2 years. An increase in property choice, alongside rising construction costs and a building industry that is approaching capacity, is helping to switch would-be renovators to upgraders instead. This is a trend which is likely to persist throughout 2022, especially if advertised stock levels continue to rise. At the nationwide level, there are now more properties available for sale than at the same time last year, and the difference is quite substantial in some parts of the country. This is most notable in Wellington, Manawatu-Wanganui and Hawke's Bay regions, where there are almost twice as many properties listed for sale now than a year ago. While advertised supply is up, it's important to recognise that this is mostly due to the reduction in sales transactions and not a significant lift in people listing their property. So for as long as there's no rush to the exits for property owners, there's no real need for panic. But the rebalancing of demand and supply is already leading to vendors having to adjust their price expectations. Fewer sales alongside consistent listings means the balance of power has started to shift, and this is shown in the latest House Price Index data, which measures value change over time. According to the Rhines HPI, values have now fallen for 2 months in a row, culminating in the nationwide index dropping by negative 2.6% since the end of November. This level of turnaround was somewhat unexpected, as a gentle slowdown seemed more likely, but perhaps it shows the true influence of the change in availability of credit. The annual rate of growth, according to the CoreLogic HPI, has now moderated to 27.5%, down from the peak rate of 28.8% at the end of October 2021. Market sentiment has clearly shifted, and this could be the greatest determinant on where things go next, alongside any modifications to the CCCFA. The government is currently investigating any unintended consequences of the changes to the Act, and whether tweaks should be made for mortgage lending. This does seem likely, but we're yet to understand how significant they'll prove and any market reaction. For now, we have to expect reduced demand and market weakness to continue. This is especially the case when you add in the impact of rising interest rates. The standard 2-year fixed mortgage rate is already 1.2% up from the trough, and all predictions are for further increases to come. Persistent inflation, which hit 5.9% annual growth at the end of last year, and a strong labour market where unemployment is at a multi-decade low of 3.2%, both set the scene for the Reserve Bank to continue to hike the official cash rate. Perhaps the weakness in the housing market, given how significantly it weighs on our economy, will provide them with cause for pause, but it's unlikely to change any decision making in the short term. Keep an eye on consumer sentiment then, as the psychology of market participants can exaggerate any embedded trends, particularly in a negative way. For now though, the strength of the employment market will act as a support for the property market. And with mortgage serviceability tests and responsible lending standards preparing buyers for times like these, the impact of increasing interest rates is likely to be felt mainly on the demand side, as opposed to leading to distressed sales on the supply side. Of course, there will be regional differences, and affordability, or perhaps more appropriately unaffordability, will play a part in how the market pans out. Our recent housing affordability report, available at CoreLogic.co.nz, provides the perfect line in the sand for every city and town across the country. And we'll continue to provide more regular reads on the latest data in our weekly property market podcast, available in all podcast players. Mā te wā.